In this session we shall look at how we calculate labour variances. Now our first type of variance is the direct labour cost variance, and this is the difference between the standard direct labour cost we should have incurred for making our actual output and the actual direct labour cost that's been incurred. When we look at our variances, these can be either favourable or they can be adverse. Favourable variances, these occur when our actual costs are lower than standard or where our efficiency is better than standard. So basically it's where we've performed well. Our adverse variances, these occur when our actual cost is higher than our standard cost and our actual efficiency is lower than standard efficiency. So basically we're saying adverse variances occur when we've performed poorly. Let's have a look at an illustration of how we calculate direct labour cost variance. So last month a company has made 1,000 units and it incurred direct labour costs of £1,375. The standard direct labour cost of producing one unit is £1.25. So what we do, first of all, is we calculate what the standard direct labour cost of making the actual number of units produced, which is 1,000 units, will have been. So that's going to be 1,000 units at £1.25 per unit. So we've got a total there of £1,250. But our actual cost was £1,375. So the difference between those two figures is our direct labour cost variance, and that works out at £125. Now we know that that is adverse because the actual cost is higher than our standard cost. So for whatever reason we've incurred more costs in making those 1,000 units than we'd expected. Next we'll have a look at how we can break up our direct labour cost variance into two separate components, the labour rate and labour efficiency variances. When we look at our overall direct labour cost variance, we can split this into two separate elements. Firstly, we can identify what the variance is that's caused by differences in the rate per hour paid for our labour, and this is called the direct labour rate variance. And secondly, we can identify the variance that's caused by differences in the time that's taken to produce the units. And here this is known as the direct labour efficiency variance. Now when we looked at the direct labour cost variance earlier, we compared two figures. We compared the standard labour hours at the standard hourly rate for actual production, so that's the amount we would have expected to incur for the amount that we produced, and we compared that with the actual direct labour cost incurred. And the difference between those two figures was the direct labour cost variance. Now if we're going to split that direct labour cost variance into two different elements, we need to calculate a third figure. And the figure that we calculate is the actual labour hours at the standard hourly rate. Once we have that, we can now calculate both our labour efficiency and labour rate variances. We compare, first of all, the standard labour hours for actual production at the standard hourly rate with the actual labour hours at the standard hourly rate. And the difference between those two figures is our direct labour efficiency variance. Lastly, we calculate the difference between the actual labour hours at the standard hourly rate with the actual labour cost. And the difference between those two figures is the direct labour rate variance. Now let's have a look at an illustration. So a production labour budget for the last week is shown below, together with the actual performance for the week. So we should have produced 100,000 units, we actually produced 112,000. We expected to use 500 labour hours, we actually used 540, and we thought we would incur a direct labour cost of £3,750, but our actual labour cost was £4,131. So first of all, I'm going to calculate what the labour cost should have been for the actual number of units produced, 112,000 units. Well, if 100,000 units cost, or should have cost, £3,750, I can calculate what 112,000 units should have cost. This is going to be 3,750 divided by 100,000 multiplied by 112,000, and that gives me 4,200. That's the amount that the actual production should have cost me. So I can calculate my overall direct labour cost variance. This is going to be the 4,200 that I've just calculated minus the actual cost incurred of £4,131. That gives me a difference, a variance of £69, and that will be favourable, seeing as though I actually incurred a smaller cost than I would have expected to had my actual production cost me what I thought it should do. The second step is to calculate how much the actual hours that have been worked should have cost. Well, first of all, I'm going to calculate what my standard direct labour rate per hour is. Well, according to my budget, I had a cost of £3,750, and that bought me 500 direct labour hours. So that works out at £7.50 per hour. I can now calculate the actual hours at that standard rate per hour. So the actual hours were 540 at £7.50 per hour. Those actual hours should have cost me £4,050. Now we've calculated all of our numbers, we can calculate the variances. Well, my standard labour hours for actual production at the standard hourly rate, we calculated that to be £4,200. We also calculated the actual labour at the actual labour hours at the standard hourly rate. That was £4,050. And our actual direct labour cost was given in the scenario at the start of £4,131. We've previously calculated that direct labour cost variance at £69, and that's a favourable variance. But now we can calculate our efficiency and rate variance. Well, the efficiency variance is going to be the difference between that standard labour hours for actual production at the standard hourly rate and the actual labour hours at the standard hourly rate. And that gives me a difference of £150. And it's a favourable variance, as the actual labour hours at the standard hourly rate is less than the standard labour hours at the standard rate. Lastly, we can now calculate the rate variance, and this is going to be the difference between the actual labour hours at the standard hourly rate and the actual labour cost. And here we've got a variance of £81, and this is adverse because we've obviously must have paid our direct labour at a slightly higher rate per hour than the standard rate per hour. The final thing that I would draw your attention to is the fact that if we add our direct labour efficiency variance to our direct labour rate variance, we end up with our direct labour cost variance. And this is always going to happen because all we're doing is we're splitting out that direct labour cost variance into two different elements.